What's up everybody, Nate here, and I want to take you back to 2021. The Dogecoin boom was in full swing, the stock market was in a bull run, and inflation wasn't the most talked about thing that we were discussing at the end of the year. This was also a time when the Federal Reserve had started to talk about this idea of inflation, and many of us had just heard of inflation for the first time. The Fed back then was saying that inflation was not really an issue and it was simply transitory. It's not going to be a problem in our economy, and eventually it's going to just disappear. Now flash forward 2 years, and the Federal Reserve has been aggressively raising its rates since around March of 2022 in order to combat inflation and bring it down from its high of 9.1%. But that is causing some issues in our economy. Namely, we're starting to see things like unemployment go up, we're starting to see startups and other businesses throughout the country shut down, and consumers are getting squeezed because they're not able to buy as much. All of that could end up leading us into a new recession, which begs the question, was the Federal Reserve wrong in its assessment of our economy? Well, before we answer that, I want to talk about what the Federal Reserve just did and what it's been doing over the last couple of months. The Federal Reserve over its last 2 meetings has decided to pause its interest rates. Now, what that means is it's not going to be raising its interest rates any higher for the time being. The past 11 meetings, the Federal Reserve has decided to raise its rates from around 0.25% all the way up to 0.75%. What this means is that they're making it a lot harder for everyone in our economy to access money. What you need to understand here is that money is created from the Federal Reserve and the Treasury Department. So anybody that wants to use money, from banks to consumers, it has to originate from those sources. And if they make it difficult for banks and other people to get money, well, then that means there's going to be a lot less spending, hence the higher interest rates. Think about an interest rate on your mortgage. If an interest rate on your mortgage is a lot higher, then you're going to be paying more, and you might not be able to afford that interest rate, which means you can't afford to get that house or that car or spend on a credit card. This sort of trickles down to everything in our economy. So what you need to know is as those Federal Reserve interest rates go up, spending essentially goes down in the economy. As that spending goes down, well, the idea is that there's now going to be less inflation in your economy. You got to remember 2 or 3 years ago, the Federal Reserve and the Treasury Department printed trillions of dollars in response to the pandemic. We had around 15% unemployment by around April of 2020, and the Federal Reserve and the government wanted to sort of stimulate our entire economy, and to do that, they needed money because people weren't working and businesses weren't bringing in any money either, so they had to inflate the economy by printing a lot of money all at once so that could stimulate a lot of spending even though people weren't working. There were also a bunch of other government programs during this time, and this helped a lot of startups get going, and it helped a lot of people to eventually pay their bills and buy things that they needed during this time. But when you have a lot of spending, you have a lot of demand, and when there's a lot of demand for something, prices go up, hence inflation. We actually track this through the CPI, or the Consumer Price Index, every single month. And the Consumer Price Index has been showing inflation going up, meaning prices for everything are going up and people need to make more in order to afford them. And now you just have everything continuing to go up in an economy. And that is bad news for the Federal Reserve. So the Federal Reserve has been raising their rates in order to stop that. But why exactly did they decide to pause their rates so suddenly? I mean, inflation is still high in our economy. It's right around 4%. So why exactly would the Federal Reserve want to pause interest rates when it's clear that inflation is still elevated? Well, the reason that they want to pause interest rates is because they're kind of looking at the numbers and they want to figure out if things are going to improve in the future without them increasing rates anymore. Inflation and interest rate hikes are what we like to call a lagging indicator, meaning the Federal Reserve raises rates today, but that doesn't really have a big effect overnight. It's eventually going to have an effect as businesses start to slow down, as consumers stop spending as much, and eventually that will mean inflation does go down, but that takes time. It's not going to happen overnight. So what the Federal Reserve is sort of looking at is if they pause interest rates, are interest rates high enough right now that that is going to curb spending enough from businesses and consumers, and inflation will start to come down. That is what they're looking at. They are taking a look at the numbers for inflation, meaning prices, and the jobs market, meaning how much money people are making, how much more money are people able to put into the economy, and they're assessing if inflation is going to come down based on where rates are right now. But here's where things get a little tricky, because you have to kind of keep all of this in perspective if you want to understand what the Federal Reserve's end goal here. A lot of Fed governors have talked about sort of this golden situation from the Federal Reserve, and that means that the Federal Reserve is A, able to raise their interest rates, and B, able to raise them high enough to where it does not cause a recession or any sort of economic slowdown. But that is pretty contradictory, because what the Federal Reserve is looking for is some sort of economic slowdown. They even said in their last meeting that until job numbers really start to cool off and until we really start to see prices go down, they are going to continue to keep their interest rates high and potentially even raise them up more. The opposite thing to happen from this golden situation would be a full-blown recession or worse, and that is what a lot of banks and economists and investors are worried about right now. That's why you start to see big fluctuations and volatility in the stock market and other markets when the Federal Reserve and Chairman Jerome Powell of the Fed go on to speak. The Federal Reserve has to ride a very fine line here. That's why it's a golden situation, because all of the sort of aspects of our economy come together in the right way. But if they don't, that could essentially cause some parts of our economy to plummet, and then the Federal Reserve is going to have to do a lot of crazy stuff in order to get everything back under control again. Sort of like what we saw back in 2020. The Federal Reserve and our federal government decided to step in pretty much immediately, printing trillions of dollars and lowering their benchmark interest rates to around 0% in order to stimulate the economy. That meant that people could then go out and get mortgages and spend on a credit card, get an auto loan, and buy pretty much as they could with their dollars, because interest rates were extremely low. It was a lot easier to buy those things. Each time the Federal Reserve raises its interest rates, whether it's by 25 basis points or 0.25% or 75 basis points, that means that it gets a little bit more restrictive in our economy. So it's harder for people to go out and spend money. The tricky part for the Federal Reserve is they could easily lower inflation, probably tomorrow if they wanted to. All they would need to do is hike up their interest rates as high as they could go, and then it would be impossible for anybody to get a mortgage or an auto loan or spend on a credit card, right? But this would also immediately tank our economy, because think about what spending means. Our GDP is sort of a forecast of our gross domestic product, which means all of the goods and services that are made and sold in the United States goes into this one calculation. And it's a very important calculation because it essentially gives you a general baseline for the health of an economy. If your GDP is going up, that means there's a reason for a country to produce more, because people want more and people are continuing to spend money. They're able to do that. But if your GDP is going down, that means businesses and consumers aren't really spending or buying anything. That's bad news, because your economy is shrinking, and shrinking equals businesses losing everything, people losing everything. And that is what the Federal Reserve is trying to avoid while bringing down inflation. If rates get too high, then it's going to have a domino effect in our economy. People are going to immediately have a harder time getting loans. Like, they're not going to be able to get a mortgage as easily because interest rates are so high and they can't afford it. So that disqualifies millions of people, and that is what we're starting to see in 2023. The housing market is starting to shrink because interest rates are so high and prices are still really high too. Next, you're going to see businesses take a big hit as well, because they can't borrow as much money, and investors can't borrow as much money either to pour back into businesses. So now businesses have to shrink, which equals lower raises or no raises at all for current employees, and businesses may even start laying off a lot of employees because they don't have the cash flow to support their business. And that's if the business stays afloat. Many businesses are just simply not going to survive. Many businesses are not even going to be able to be formed because people can't get access to that business loan. And when businesses start laying off people, when businesses start shutting down, that means people are out of jobs and they're out of work. That equals unemployment, and unemployment means nobody can spend any money. So even businesses that were very successful and doing well, they're all of a sudden going to get a lot less money too, because there's just fewer people in the economy that have money. We're starting to see this too in 2023 as the unemployment rate is slowly starting to creep up. And the Federal Reserve knows this. They know that unemployment is going to go up. And more than likely, the higher its interest rates go, the more unemployment is going to rise. But like I said before, the Federal Reserve is in a really weird spot right now because the US is still adding a lot more jobs and unemployment is going up, but it's going up very slowly and inflation really isn't coming down. So what's going on there? Well, people in the economy still have a lot of money because of all of the money that was printed over the last couple of years. Saving rates in 2020 hit a record high. So people stuffed a ton of money away because of stimulus checks, and a lot of people still were employed in 2020 and in 2021. So they saved a ton and they got raises from things like the Great Resignation. Millions of people moved around throughout the United States to a different and better job that was going to pay them more because businesses had a lot more to spend because there was so much money and really low interest rates. Of course, now a lot of these individuals are still out there and they're still employed, so they have bigger and better raises and they're still spending a lot of money, but eventually that money is going to disappear as inflation continues to go up, as things get a lot more expensive, as life happens. People are going to continue to pull more money out of their savings account every single month, and people have already started doing this in 2023. Saving rates are hitting record lows, and some banks are reporting savings are beginning to become depleted. So people are spending almost 100% of their paycheck right now. Our economy is very fragile, and the Federal Reserve knows this, and we're pretty much at a tipping point right now. So with all that being said, now we can finally answer the question: was the Federal Reserve wrong? Is it possible that the Federal Reserve could have avoided this situation by starting to raise interest rates when they first were talking about them back in 2021? They were originally saying that inflation was transitory, meaning that it was because of the pandemic and supply and demand problems, right? That's what's causing inflation. But as soon as that gets corrected, it's going to go away and we're going to go back to business as usual. Well, that didn't happen, and we know that because that's not truly what causes inflation. Supply and demand inflation, that's temporary. That goes up and down all the time, but true inflation is caused by a lot of money printing, and that money is still out there. Well, if we look back at some of the things the Federal Reserve has done over the last couple of years, and you've been watching this channel for a while, then you know this is a lot more complicated of an issue than to just say that this is right or wrong and just a black and white issue. Our country was in a really difficult time during the pandemic because we had unemployment that was really high, and our leaders didn't really know how long this was going to last for, so they could have printed nothing and just waited, but that could have put an even bigger problem in our economy depending on how long economic lockdowns were going to last for. Could the Federal Reserve have started raising rates a lot sooner? Well, yes, and that could have potentially put a damper on inflation, but like I said before, this is a lagging indicator. So inflation was already going to go up even before the Federal Reserve started talking about it. Inflation was slated to rise the second the Federal Reserve and the federal government decided to print trillions of dollars. That's not going to go away. That money is in circulation and it's going to be floating around for a very, very long time. So in theory, the Federal Reserve could have raised rates and that might have curbed inflation a little bit, but it's not going to necessarily stop the issues of this kind of unemployment and startups starting to shrink and people having a lot less money to spend. Those issues were going to come about either way. And again, even by 2021, we didn't really know the full direction of the pandemic yet. Things were starting to look a little bit better. Of course, looking back, we can say, well, things were going to end, but it was a lot more complicated than that. So the Federal Reserve didn't want to be too preemptive and start raising rates when they didn't know the full direction of things yet. Now, what's coming in the future? The Federal Reserve has said that it does not plan on cutting rates anytime soon because it wants to see what the data is going to look like in November and December, and then it's going to decide what's going to happen next with its rate hikes and everything else in our economy. And at the end of the day, what you need to understand here is that right or wrong, it does not matter what the Federal Reserve does. These are conditions that are completely out of your control. You can't control the stock market. You can't control if the Federal Reserve raises or cuts their interest rates. But you can prepare your portfolio and you can prepare your own finances for whatever sort of happens in our economy. The Federal Reserve sort of does what it does based on a lot of different factors. It doesn't want to scare people by saying our economy's bad, we're raising rates, but it also doesn't want to make things too easy and just say we're going to start cutting cutting our interest rates because everything is great now. They have sort of a duty to make sure that everything is sort of stable in our economy in terms of finances. You have the same duty to your own finances and your own family. You have to make sure things are stable no matter what is going on. That's why you need to build a portfolio that goes beyond Federal Reserve interest rate hikes. That is created through diversification. That is created through understanding how money works and managing your money effectively. Always do your own due diligence. Never listen to random people online because you never know what intentions people have. So you always want to make sure you're doing your own research. But from my point of view, it doesn't matter. You need to focus on your own money first. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.